In this week's video, we'll examine the hard evidence to help us answer the question, is the bullish case getting stronger?
To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player.
We'll kick off this week's video with some charts that will help us illustrate one of the basic tenets of the CCM market model. That tenet is that we like to put our capital in harm's way when the odds are in our favor, and we prefer to reduce our exposure to risk when the odds are deteriorating, and therefore we can improve the probability of protecting our capital and leveraging the miracle of compounding and avoiding disasters. If we can avoid big mistakes, that's more than half the battle. Regular viewers and clients know that we use moving averages to help us assess probabilities. In this case, in 2007, blue, the fastest moving average, was on the bottom here. The slopes of all of them were down. This is a full-bore bearish look, telling us that the probability of bad things happening is greater here than it was here. The tight moving averages tell us that risks are increasing. From this point here, the S&P 500 dropped significantly, all the way down eventually to the intraday low of 666 in 2009. Now we're looking at the same daily moving averages in 2015, and you can see this is not a particularly attractive look from a risk-reward perspective. It is possible that a look like this morphs into a capital-destroying and hard to recover from bear market, similar to what happened after this point in 2007. The reason why we talk about maximum flexibility is because we know that an ugly-looking chart can continue to be ugly, or it can improve as it did rapidly after the intraday reversal, the first day that we bought intraday on October 2nd. You can see this is an improving look here. Still has some work to do on these time frames, but this here is starting to look a lot more like this period here that preceded a nice bullish move. All of these looks speak to nothing but probabilities. The odds of success here are much, much greater than they were here. Tight moving averages, the probability of bad things happening increases. Tight moving averages, the probability of good things happening is improving when we're looking out days, weeks, and months. Since there's no moving average on any time frame that's particularly foolproof or magical, the CCM market model is highly diversified. Same concepts here. Now we're looking at a weekly chart. This is a low probability look. From this point in this area here, the S&P 500 relative to price, after we could see this high risk look, dropped an additional 47% from even this point here to 666. So this is a significant drop. This is a low probability look, a low probability look. We can see it before we drop to 666. Therefore, if we ignore this, we are putting our capital in a situation where we believe we are taking excessive risk. A 47% drop or a 50-some-odd% drop is very difficult to recover from. Earlier in the year, you may remember, we said we had hard evidence that would allow us to be patient. This is the same weekly moving averages in April of this year. This looks a lot like these bullish periods here rather than this period here. There's a temptation when the markets drop and then go back to all-time highs to say buy and hold is the only way to go. And buy and hold does work well. And then one day buy and hold stops working well. This again is showing us an example of how we can manage risk. Why did we manage risk earlier this year? Well, this is a very low probability look, the same moving averages. This is in July and August. We can see this. This looks very, very similar to this point here when the S&P 500 dropped from the 1400s eventually down to 666. We also know that we have to remain flexible because an ugly looking chart can begin to improve at any time. How does this chart look today, and why have we been scaling back in since October 2nd? The present day chart as of the close on Friday, November 6th is trying to morph back into a much more favorable look, telling us that the probability of good things happening is better here than it was here. Therefore, we prefer to have less capital at risk here, and we're open to increasing exposure when the odds begin to improve. The CCM market model has numerous submodels that feed into the master market model. One of the submodels looks at 18 charts similar to this weekly chart here. This is what our full bore risk off looks like. This is 2008 here, and this is what an improving look looks like using two moving averages. We get price above both moving averages. Blue is above red, and the slopes of both are up. Price is below both moving averages. Blue is below red, and the slopes of both are down. Low probability look, not a good time to be making bets with our hard-earned capital. A much better look here, another reason why we've been scaling in. The S&P 500 finished the week up almost 20 points. We still have a full bore bullish look. We've gone from oversold now to overbought. Typically, good things can happen for several weeks or several months. CCI weekly has gone from an extremely rare and oversold condition up to a level where, from a probabilistic perspective, good things looking out weeks and months tend to happen after this point. Will we get retracements, daily retracements, multiple week retracements, even under the most bullish scenario? Absolutely, positively, yes, and those could begin at any time. We're focusing on the trend. Same concepts, we're just looking at some diversification, different weekly moving averages. A tight look tells us the odds of a big move are higher. A tight look tells us the odds of a big move are higher here than they were here, at least from a bullish perspective. This is a look we'd like to avoid. This is a look that we like to try to participate in. How did this chart look earlier in 2015? Clients will remember that we started cutting risk in this area here as the evidence started to deteriorate. Here we have a full bore bearish look with blue on the bottom and the slopes are down. From a probability perspective, this is similar to this look here where bad things happened and this look here where bad things happened. How does the same exact chart look today in terms of improvement? The answer is much, much better from a probability perspective. If we looked at the math here, which we have done, blue has crossed back above all of these moving averages, telling us that the probability of good things happening is much more favorable today than it was here, 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 or even here. Does that mean we're going to go straight up from here? Absolutely, positively, no. Just like we didn't go straight down from here, and we didn't go straight up from here either. All of this just simply speaks to probabilities given the knowns that we have today. If the knowns change, the probabilities change. We've covered all this before, so we'll move quickly. Let's get back to the evidence tends to build on itself over time. October 2nd in the video, we went over the key reversal bullet points. October 9th, we said the next week we had a breath thrust that aligned with those key reversal bullet points. On October 9th, we also talked about how overhead supply may or may not be a problem. that it offered possible resistance. October 16th, we got more good news when we covered the bullish TDST breakout, which is a proprietary DeMark indicator telling us about trends from Market Studies LLC. October 23rd, we covered the runaway gaps. If you're a bull, the good news is those gaps have held and they have not been filled. Last week we talked about that. 2 weeks ago, the market had a reason to sell off hard in the form of the Fed statement that hinted that an interest rate hike might be coming. Not only did the gaps hold, but we had a strong bullish reversal on October 28th. Fast forward to this week. We can make the same argument that the gaps and all of the information that we've covered in the past few weeks is still intact. And on Friday, the stock market had another reason to potentially sell off hard if it wanted to. The employment report came in way above expectations, which increases the probability of a Fed hike. Obviously, increasing interest rates can be a drag on the economy and earnings. The market has to balance that against an improving economy. We did sell off during the session on Friday, but we rallied hard again into the close. Are there things to worry about? There's always things to worry about. There's no such thing as a perfect day to invest. We're talking about the weight of the evidence. We still have the bullish break above the fibs, telling us that the probability of this being a new bullish trend is better today than it was when price was down here. That's still intact and it still holds today. This is the chart we covered last Friday on October 30th. And remember, we made the case that 2015 looked less susceptible to a big counter trend move relative to 2011. Another way to say that, 2015 looked stronger than 2011 did off of the low. How does the exact same chart look a week later? It still looks good with numerous forms of potential support below. This is one of the trend lines that we looked at last week, and we said it's probably not that big a deal, but it's prudent to see what happens here. We were able to clear it and close above it. The longer we stay above it, the better. This is not a showstopper area. No level or indicator or any input taken in isolation is a showstopper. However, these levels are more important. If you're a bull, you would prefer to see the band between 2063 and 2020 hold. We're still above it. RSI also made a new high for the rally when we made a new closing high earlier in the week. All things being equal, all of this looks good for now. Obviously, it's subject to change. This was as of 3:37 on Friday. We actually closed a little bit better than the look on this chart. NASDAQ daily as of the close on Friday, November 6th, 3 points. Still above potential support here. Point number 2, we're holding this gap here, which keeps the runaway gap scenario that we covered a few weeks ago on the table. And daily momentum still looks good as well. Also, daily NASDAQ as of the close on Friday, November 6th, 3 points. Price has recaptured the 100-day in blue, the 200-day in red, and we held intraday on Friday during the sell-off at a logical level here. NASDAQ weekly, similar points. We're above the 50-week moving average and the 200-week moving average, and the slope of the 50-week moving average is bullish and positive. We also recaptured overbought territory on weekly momentum, and as regular listeners and viewers know, as well as clients, that's not a bad thing. As long as you stay up near this area, good things can happen. Last week we said it was prudent to see what happened on the Dow at this level here. This is the same trend line using candlesticks. In this case, we broke above it this week, and we've held above it this week. All things being equal, if you're a bull, the longer we stay above this line, the better. If you're a bear, you'd prefer to revisit this area here. One of the most successful soccer coaches in Europe made an observation that the key to success isn't necessarily motivation, but consistent motivation. Consistency plays a big role in what we do in terms of implementation with the market model. Here's a real-world example where the consistency can pay off. This is our double bottom in 1998. From this point here, the market gained an additional 27%. There's no free lunch in this world, and that's true in the markets. If you're going to protect your capital from devastating and capital-destroying bear markets, you have to pay some insurance premiums, and sometimes you have to go through difficult periods. We won't cover this chart, but as you can see, this is a very, very difficult period in 1994. Frustrating. If we were running the model during this period, many people would have said it doesn't work, and they would have given up. This is an excellent example of the importance of consistent execution during difficult periods. Why? After this mess, if you were disciplined, the math would have eventually gotten us in the right place and help us participate in what followed, which was a 42% gain from point A to point B. Is not atypical for difficult and frustrating periods to be followed by easier periods. Last week on October 30th, we showed this chart and said it was prudent to see what happened at this area of potential weekly resistance for the S&P 500. The answer is much better. We've cleared resistance after the 19-point gain in the last 5 trading sessions. 40, 45, and 50-week moving averages. 1994, tight sideways. Today, they're tight, and we've cleared it. Not making a direct comparison to any year, just talking about probabilities from a mathematical perspective. Remember last week we said this white space in here looks similar to this white space here. Here's the close. This is what 1998 looked like. In 2011, first push up, we only closed above the MAs for 1 week, and then we reversed sharply. Once we closed for 2 weeks, good things happened. Now we've closed above these for 3 consecutive weeks. Similar concepts. Remember a few weeks back we said in 2007 and 2008, we only closed above the 100-week moving average for 1 week. Now we've closed above the same 100-week moving average for several weeks. On a daily chart, the S&P 500 has done a nice job holding above the 50, 100, and 200-day moving averages. We posted this chart during the day on Friday. It came down to an area of logical and potential support and held. This is an update to our double trend channel, lower end of the channel, high end, lower end, high end, lower end, high end. If we went from the lower end to the high end, we would clear 2130 on the S&P 500. No predictions here about anything. We're just speaking to probabilities of good things happening relative to the probability of bad things happening, which is never 0. We'll close with an important point about markets and the market model. Typically, this is the S&P 500 back in 1993 here. Typically, when you have a frustrating period, you go on to make significant higher highs. A frustrating period, significant higher highs. frustrating higher highs, frustrating significant higher highs, very frustrating, very significant higher highs. Therefore, under normal market conditions in 2015, it's not unreasonable to expect the S&P 500 to go on and make a higher high. No predictions. That's just a probabilistic statement based on the data that we have in hand now. As always, we'll head into next week knowing that the charts, the data, the risk-on, risk-off ratios, and the market model will guide us if we're willing to listen with a flexible, unbiased, and open mind.
How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.